But this is really a rally that's just like one stock. So the market's very narrow. The economy's clearly weakening. If you look at things such as financial conditions and credit spreads, and that's what I would really look towards to let me and my investors know when we need to get short, net short in the portfolio, they're still quiescent, remarkably. But this data that's coming out just over the past month or so is really starting to lend credence to the fact that we are slowing towards a recession. I think it's inevitable that we have a recession by the end of this year.
The odds of it happening, at least the ratios correcting, the law of averages, a regression to the mean coming into the fold, it's to me as good. It's a trade of a generation, maybe. It's a trade of a decade. I don't know how else to say it, because you don't get opportunities like this very often, where a double would be just returning to its average. Usually doubles require massive amount of risk, and this would just be being average and getting back to what it's averaged for 200 years.
The dollar is going to collapse. The question, I don't think, is will it or won't it collapse? It's when. That is really what we're now seeing. We're coming towards an end game, and we can see this rising.
In today's weekly recap, 3 financial experts, Alasdair Macleod, Michael Pento, and Andy Schectman, talk about the most relevant events in the precious metals sector. We watched hours of their interviews to bring you the best clips so you don't have to. In today's show, we discuss the recent news about China and Russia accelerating the gold standard 2.0, the volatility in gold and silver prices, and how the macroeconomic environment is fueling the bull market moving forward. If you're into gold and silver, make sure you like, subscribe, and turn on notifications so you do not miss out our recaps. Enjoy the episode.
The short exposure was actually a very successful raid, if you like, on the stupid longs. And that's all it was. And of course, now we're sort of recovering a little bit. We've got the Fed meeting this evening. It's not expected that there will be anything coming out of that. However, what's interesting is that Lagarde lowered the ECB's deposit rate by 0.25% last week. Now, not that I've got a lot of respect for Lagarde as a banker, but I would doubt if her office hadn't been talking to opposite numbers in the Fed, in the Bank of England, Bank of Japan, so on and so forth, before taking that decision. So, it could indicate that these guys are getting together to try and force the rates down without, hopefully, from their point of view, encouraging a resurgence of inflation. But that ignores actually what inflation is. It's a falling purchasing power in the currencies, which is actually why gold appears to be rising. It's not gold rising, it's these currencies falling. And, people so often make the mistake of, thinking that the People's Bank of China is buying gold. No, they're not. They're selling dollars.
Inverted yield curve inversion, so the 10s minus 2s inversion in history. The longest inversion, which really brings down net interest margins for banks, because how do they make money? They have to pay their depositors, but they're collecting interest on loans. Well, if the interest they're collecting on loans is equal to or less than what they have to pay on deposits, it's a pretty hard way to make money. And if they don't want to raise their deposit rate, you have something called capital flight. People take their money out of the bank and they moved it to brokerage accounts, and you end up with a lot of money flooding into T-bills. So that's what's occurred. In fact, if you look at the reverse repo facility, something also I look assiduously at, is that has equated to the draining of that reverse repo facility, which is excess reserves from banks that was parked, laying fallow at the Fed. That has pushed, just in the last 12 months, $1.7 trillion of gambling money into Wall Street.
I think what it does is it slowly and continually erodes its value and its demand. The dollar is not going away today or tomorrow, but when you realize that these countries can now use any currency they want, it starts to chip away at the settlement value of the dollar. And again, there hasn't been a challenger to the dollar But it appears very, very, very obvious to me that commodities, in particular gold and oil, which seem to be remonetized across the globe, are replacing the role of the bond market. And in particular gold, but a bond that can be weaponized and stolen or confiscated the way that they're doing right now with the Russian assets and inflated or defaulted upon. I might be one of the few people that really believe rates are going way higher. I know Martin Armstrong does too, but everyone talks about rates being lowered. I
In
see
today's
rates
news
going
recap,
higher.
silver leads the breakout for gold, but resistance looms. Soft U.S. retail sales data has rekindled hopes that the Fed may have more leeway to cut rates sooner than they're letting on. This has provided a nice bounce for metals, with many now waiting to see if momentum can be sustained when U.S. traders return to their desks. Silver is up 2.3% and at a 9-day high after breaking back above $30 near the end of the session. After a bit of a delay, gold is now catching a bid and is up 0.6% ahead of the European Open. Given we're hours away from two central bank meetings, sentiment can easily shift. If metals are rising on dovish expectations for the Fed, they could potentially give back some of those gains if the Bank of England or Swiss National Bank are not as dovish as hoped. Silver technical analysis. Current high has stalled around trend resistance. This is a bullish breakout from the consolidation around the 50-day EMA, so overall it appears constructive for further gains if or when resistance is cleared. The 1-hour chart also shows that the daily high lands around the prior retracement, which adds weight to the case for an interim top. Lastly, the daily RSI is now within overbought territory, along with the 4-hour RSI. In the hours before silver broke out, gold looked like it wanted to break higher, and if it did, it was not a breakout to be trusted. The price action of the last couple of hours has done little to sway this opinion. Gold's breakout is lackluster in comparison, meaning bulls are driving prices higher with less conviction. With the monthly pivot point just above $2,350, any move towards this level could attract bears seeking to fade the upward momentum. Now, we'll show you the latest clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily
So that money
recaps.
came out of the
Enjoy
reverse repo
episode.
facility, went in to buy bonds, newly issued bonds. That money is circling in the economy. And that's when you get, roaring kitty stocks going through the moon, and you have Nvidia going up, the market cap of Berkshire Hathaway in a few days. It's insane. But that's $1.7 trillion is now, there's only about $350 billion left in that reverse repo facility. And I'm really watching the bond market, because when that liquidity runs dry, and it's not too long away now, it's very close. Talking about months, not quarters. I think we're going to have a lot of problems in the repo market, in the money markets, in the stock market, and in the bond market. Those are the things I'm looking at, Donegan. It's not time to panic yet. I'm just saying, if you're going hog wild over your skis in Nvidia and going golfing and enjoying your life and saying, you know what, all you need to own is the number one stock in the AI phenomenon, you're in for a rude awakening. Because in my 33 years of doing this, being a licensed professional, this type of scenario has never ended well. And I look at something like the market cap of equities, total market cap of equities to GDP. It's 190 something percent right now. That's the highest reading ever.
This is a game that will not end very well for people who are holding traditional assets as rates go higher. And I think that's going to happen. I really, truly do. I think rates will go much higher, because even if the budget was balanced today, who's going to pay for the 150 trillion in unfunded liabilities? And who's going to continue to hold the US dollar that can be weaponized, that's going to see rates rise, where a country that's chosen inflation over austerity, but as rates rise, it's going to destabilize all of the bonds in circulation. So between the issue of default, of inflation, of instability, where last year was the first year in 45 years where gold had less volatility than the bond market, a country that has chosen to weaponize its treasury market, these commodities are becoming more valuable than the currencies backing it. So yeah, I just see a period of time where countries are going to trade with local currencies with one another, and use gold and oil as a default settlement, which will continue to erode the value of the dollar in all of the trading and the settlement, and then completely erode the reserve status as bonds are sold and commodities are purchased. Now, when they issue a gold-backed settlement currency, that really changes the game because, I guess the bottom line with all of this is that they settle, they trade in local currencies, they settle in this common settlement currency, and reserves would go into gold instead of into treasuries. The combination of that chips away tremendously at both aspects of the dollar hegemony, the reserve and the settlement status. And the pushback against so many of these dollar bulls is the bond market, the bond market, the bond market. But who the hell wants to hold any of our treasuries of any duration?
And now Macleod wraps these events to the COMEX Shanghai arbitrage and the short and midterm consequences for gold and silver stackers.
This is something that has not been covered in the mainstream media at all. The end of the 50-year agreement whereby Kissinger and Nixon agreed with the Saudis to provide them with defense, security for the nation, in return for which all oil would be sold in dollars. That agreement was a 50-year agreement. It ended on the 9th of this month. And so we're in new territory. And we know that the Saudis have probably broken this already anyway, because they've been selling oil to China. As I understand it, the settlements have been in yuan, at least some of them anyway. So I think that this is actually a major point. I mean, the oil for dollars really was, if you like, the ground upon which the dollar has stood since 1974. That's now gone. This could well accelerate. It is very, very concerning. There is another aspect in this, and I'd be interested in your thoughts too, and that is the demand for gold. We've been talking about it migrating from west to east, and particularly China, which is the Hotel California for gold, really because it needs it as an industrial metal. But India has become a major buyer, really, again, for industrial purposes, because India is ramping up its ESG credentials. The government is encouraging and I think even subsidizing the production of photovoltaic cells. And so, I mean, Reliance Industries, one of the major conglomerates in India, has recently opened a factory which produces 5 gigawatts of photovoltaic cell output. Needs a lot of silver. And so where do they go? I mean, it looks to me like they've been standing for delivery on COMEX, where, I think over 1,500 tons has come out this year. We're talking about quite serious quantities. And, stocks in the vaults, free stocks as opposed to stocks which are actually sort of held by ETFs or other serious holders, as it were, long-term holders, that liquidity is actually diminishing very substantially. So there's a huge squeeze. And of course, nobody on the short side in the paper markets can close their positions. I mean, it is actually, I think I can see the possibility of a crisis in the bullion banking community. I mean, not just on silver, but also gold, where they cannot close down their position. And if you look at the producers on COMEX, when we had the spike up to $1,900, was it September 2011 or 12? The producers category was net short of about 200,000 contracts. This time, they're short of less than 50,000. So you can see that the burden is actually on the swaps, and they can't escape from it. They can't turn around and tell the miners and so on, look, sell your production forward so you can guarantee your cash flows, which is the old story that they do, because the miners aren't having it anymore.
What do you think of today's episode? Do you think these guys will hit the nail on the head, or will they be massively wrong in their gold and silver predictions? Post in the comments section down below your honest opinion about what's next for gold and silver. Share this video with a silver bug and send a super thanks if you find our recaps valuable. Thanks for watching. Check this video right here as well because you'll like it too. I see you on the other side.